This market is still sending mixed signals. Inflation is cooling, markets still expect easing, yet long-term yields remain stubbornly high, and financing costs are not falling the way many hoped. The curve has steepened, but not because long-end risk has disappeared. If you assume eventual Fed cuts will do the heavy lifting for borrowers and investors, this environment should give you pause, because today's divergence is not just a policy story. It is a structural story about supply, duration, and the market's required compensation for long-term risk. For commercial real estate investors and financial operators, getting that wrong affects hedge decisions, refinancing windows, and long-term returns. Let's examine what the market is really saying. Here's Derivative Logic's John Rothfield.
I'm going to talk today a little bit about obviously the new so-called known unknown that's come into the outlook for the economy. And, as a chief economist for a pension fund, and before that, an economist for an investment bank, one of the things that saves you from being wrong with your outlook is that new known unknowns happen that represent right and left tails to the outlook for things like interest rates and currency. And, so this is clearly one of those. Just when we thought we were settling down into a period of greater certainty, the boost to the economy from the one big beautiful budget bill was happening this year. There was no more firing of federal workers to go on into the economy. And then we decided to, have this Middle East adventure, which, as Steve alluded to, increases both the right and the left tail risk to the outlook. And if anything, and I'll discuss this a little bit as we go along, the question is, in 1989, 1990, the US economy was increasingly fragile due to things like the savings and loan crisis. And the Gulf War essentially pushed the US economy at that time into a fairly mild and short-lived recession, but it did go into recession. But also at the same time, inflation went from about 4.5% to 6% temporarily. So this is one of the more interesting things that'll come up in today's What I Learned This Month. So how did we go into this war? So the economic data has been what I would call bumpy and perhaps unreliable recently. But on balance, I think the US economy was robust into the latest war. In terms of both, particularly in terms of GDP and other kind of partial indicators like soft surveys of participants in the economy. I agree with something that was recently said, and I don't want to totally paraphrase, but the chief economist from Goldman Sachs, Jan Hatzius, is quoted as saying that when you look at AI, it's actually been a wash for GDP growth. This narrative that the economy has relied on AI for growth, except through the household net worth channel, through the inflation of asset prices, hasn't really been significant because of the idea that a lot of the inputs into the AI build are coming from abroad. The relationship between GDP, which grew, 2.25% to 2.5% during 2025, and jobs growth, which was less than 0.25% or around about 0.25%, was actually not that unusual. And I still think that in 2026, we may, depending on the tails, get a similar outcome, fairly solid GDP growth, but without many new jobs being created. That is a sustainable situation, depending on things like productivity. Inflation was quite benign. We had February CPI data out today. There are a couple of little things to worry about, but we are not going into this situation with, excessive worries about inflation. So unlike the first Gulf War, ultimately, I don't expect this one to pull the US into recession, although, of course, that tail risk has increased. So let's go through a few of the slides here we'll not race through them, but give you an idea that of what I'm thinking and why. In 2025, domestic demand, which private domestic demand, which is called private domestic final purchases, had a 2.5% year. The forecast for the first quarter of 2026, according to the nowcast by the Atlanta Fed, is only 2.1% for that portion of GDP. But I think that's going to be revised up. One of the things is the Atlanta Fed can't account for the fact that the one big beautiful budget bill and various other things like no taxes on tips, various other handouts to consumers is going to increase spending toward the back half of this first quarter. So we're going to see an upward revision, or actually the number when it comes out on April 30th should potentially be more like a high twos for domestic final purchases. And then we're going to get a rebound in government after the war ended. So I think a 3 handle is more likely on first quarter GDP. Now that follows a 1.4 we had for the fourth quarter, which was affected by the government shutdown. So, but if you add 3 plus to 1.5 plus, you get 5%, which is about 2.5% growth. So the economy is growing at about 2.5% when all of this noise in the data is taken out, and GDP growth and private final demand growth has been quite steady in that 2.5% real range before you add inflation to the top. Just quickly looking at the winners and losers during 2025, in consumer spending, a lot of the increases in spending were in the services areas because of the stock market, big increase in commissions paid, gambling, drugs, social assistance, that kind of thing. Not exactly encouraging things that increased money is being spent on. Childcare as well. This is real access to childcare because working age population has increased their participation in the labour market. So you've had an increased resort to childcare. And then on the investment in structure side, the only games in town have been data centers and alternative forms of electricity generation. And then something that J.D. Vance and the rest of MAGA was looking forward to, we've actually seen. The number of checkpoint travelers through the TSA has gone up sequentially, an increase of 2%. So far in 2026 after a 1% increase in 2025. But foreign arrivals to the US for tourism have been declining sequentially. And that has, of course, put a dent in domestic service spending. But that was one of the known consequences of what the administration has been doing on the global area. Now, I have a kind of an everything chart or heat map which looks at various surveys, all the regional surveys by the feds, the ISM for manufacturing and non-manufacturing, and the National Federation of Independent Businesses, which are small businesses. You can see down the bottom in January and February, overall there have been some green shoots. Things were really bad back in April and May when we first had the Liberation Day tariffs. There was a second wind in November and December when we had the government shutdown and a few other things were happening. But January and February has actually seen some green shoots in the economy that is partly based on this idea that we have these headwinds from the government turning into tailwinds in 2026. Now, this idea that, again, not to totally paraphrase Jan Hatzius, but so what has AI done for GDP? Remember, we had about 2.25% to 2.5% GDP growth last year, or domestic demand growth. If you look at things like investment in equipment and software, R&D, and data center construction, with data centers actually a small proportion, AI added about a point to GDP, that 2.5% GDP growth during 2025. But remember that a lot of that input into that system, and that won't be the case forever, but the input into that system is the purchase of imports of computer equipment and other chips and other various things related to that from abroad, particularly from Asia. So when you take out computing imports, the contribution to GDP from AI has essentially been a wash. If you take those 4 quarters of 2025, it's been a wash. So what does that tell us? It tells us that yes, AI has been good, particularly through the household net worth channel by the inflation of asset prices and the spending that has followed from that. But if you look at just raw GDP, it hasn't been much of a net add. And so you can't rely on that if something goes wrong to be going along in the background, sustaining economic growth. And then, this is just the point essentially that, AI has essentially increased the GDP of North Asia, South Korea, Taiwan, Singapore, and Hong Kong. Their exports, ex-Japan, have increased rapidly during 2025. And even China, which kind of exports into those countries and those exports end up in the US, their exports in January, February 2026 were very, very strong. So yes, AI has been a phenomenon that has been helpful through the stock market, but it hasn't added to US GDP growth as much as it has to Asian economic growth. So the fog of war, here we go. So there are two alternatives here. On the right-hand alternative, I don't really take that seriously. After George Bush went on to I think it was the Abraham Lincoln, and declared mission accomplished, as President Trump has recently in terms of Iran, you had a long drawn-out war, but the actual growth in the economy in the 2 years that followed that announcement of mission accomplished, the economy actually grew quite strongly. We were coming out of the tech recession, and the Greenspan was keeping interest rates relatively low, and we had fairly strong economic growth. The scenario I'm worried a little bit is on the left-hand side, which is that you had a fairly shaky economy going into Desert Shield because of the S&L crisis. So you can see on the left-hand chart the four bars on the left-hand side of that. Economic growth was about 1%, but it was very volatile from quarter to quarter, and the economy wasn't going that well. You still had some credit issues surrounding the S&L problem. Nothing like the GFC, but there were some problems. And you went into Desert Shield, and then you had a bona fide recession for a couple of quarters. And then growth after that turned out to be fairly uneven. And as I mentioned, one of the things that happened is that not only did growth decline, but you did get an increase in inflation. Now, I don't think that we're in a situation as vulnerable as that, but certainly the market had already started to price in some problems with private credit, various other extensions of loans. But they tend to, I think, more be sectoral issues. And I don't think we're going to get a repeat of that. But as I said, that kind of left tail risk has probably increased to about 20 to 25%, depending on what happens now with the war and what happens with energy prices. Oil impacts on the CPI. Well, Torsten Slock from Apollo Management had done this famous chart on the right-hand side. And here we are. We've almost replicated the first inflation event that we had in the mid-70s. And then in the 80s, inflation in the US took off again. And here we are right now at the cusp of this. The fact is that back in those days, energy was about 10% of consumption, if you've taken all accounts of energy. Right now, energy is only about 5% of consumption. And what's interesting is that both gasoline, auto gasoline, and utilities are each about 3% of CPI. So they kind of have an equal weight in CPI. Gasoline prices through oil, Brent and WTI, could go up, but natural gas is the main driver of utilities inflation, that other half of energy in CPI. And we haven't really seen a pickup, as far as I've seen so far, of Henry Hub and other natural gas prices. And the question here is, what is the mechanical impact? If Brent goes to 100 and stays there for a year, then you add about 8 or 9 tenths to the CPI. Just looking at the impact of Brent on regular gas and then regular gas on the CPI, you end up with about a 9/10 increase in the CPI, which is currently running at a 2.5 rate, so it could get up to 3.25 to 3.5%. But people would tend to potentially look through that unless it starts feeding into wages because of some kind of tightening of the labour market. So we're definitely in a low-speed jobs market, and the question is, how does the Fed view that? Because both supply of workers and demand for workers has slowed down. The New York Fed has gone on the record saying that basically when you look at lower supply and lower demand, the labour market is still roughly in balance. And you can't make Fed policy when employment's only growing at 50,000 a month, as if it was back in the old days when steady state jobs growth was 120 to 150 a month. So what's happening here? There has been a rapid increase in the number of business applications in the economy over the last couple of years, and that's partly obviously related to, well, not obviously, but I think it's related to AI. It's easy to set up a business, and it's easier to monetize a business if you have a comparative advantage or relative advantage in this. But these guys aren't tending to hire many people. You look at small enterprises through the ADP data. Their hiring has flattened out in the last couple of years. And if you look at the small business survey, the headline has increased since President Trump got elected, but the employment component of the small business survey has kind of gone sideways. It has increased a little bit recently, but not that much. And then a study that was done by researchers at Stanford, Condi Rice's old university, shows that the main people who are being hit by AI are the younger cohorts, 22 to 25-year-olds and 26 to 30-year-olds in the areas of software development and customer service. So mature age workers and experienced workers are still managing to show slight increases in their employment, but this crucial group of young people is seeing a downturn in demand for their services. One of the things that BCA is worried about is that we're about to potentially enter the kink in the so-called beverage curve. So the private job openings keep declining from here, and we get the next data on that ominously on Friday the 13th. You can start to get into a situation where there's a kink in the beverage curve, which means the unemployment rate can start to increase more rapidly than it has so far. I personally don't think that's the case because I do think we're in a constrained supply labour market, but it is worth watching out for this beverage curve, because if we did start obviously to move along the flatter part of the beverage curve, then the Fed would be more likely to ease rates. And then on the supply side, I just wanted to mention here that, we have eliminated a lot of foreign-born worker jobs. According to fairly unreliable data from the BLS, the number of foreign-born workers in the economy declined by 1.6% in the latest year. But we haven't really had that offset by the number of native-borns. As I mentioned before with the childcare issue, men and women aged 25 to 54 have stepped up to the plate, that prime age working population. Have increased their participation in the labour force. But you have this ongoing problem of boomers opting out of the labour market. And then you have particularly men aged 16 to 24 are not coming into the labour market. I'm not sure what they're doing. They're not going necessarily increase into education, but they're not in the labour force. And from a race perspective, it's mainly white workers who have been part of this decline in the labour force participation rate. So low demand for new workers, low supply. What does the Fed do about that if the one is balancing out the other? Now we come to the issue of productivity. So during 2025, private final demand increased by 2.5%, jobs only increased by 0.2. That's a gap of 2.3 points. In the whole period leading up to 2025, during the pandemic, that gap was a little narrower. And for, in the past 40 years, that gap has been roughly 2%. And we had a gap this year of 2.3%. That gap is not particularly unusual, that gap of 2.3 points between the number of workers and GDP. And we can continue that because a lot of this is due to an increase recently in productivity, etc. So I think that we can continue into this vein. And remember, in 2026, just because we're not going to get any more firing of federal workers, I don't think so anyway. They've got rid of most of the federal workers that they wanted to. We'll probably get a 4/10 or so increase in employment in 2026 to go along with another year of 2.5% GDP. So again, I'm not worried about this disparity between jobs and GDP from that perspective. And then, productivity, we had a revision up in productivity because of the downgrade to the number of workers in the economy in 2024, 2025. So we're back in this mode now of almost 2.5% to 3% productivity growth for the last few years. And one interesting thing is, so on the left-hand chart, we're in the mode where productivity growth of around 2%, and unit is kind of associated with unit labor cost growth of only 2% as well. We're not in those kind of low productivity, high unit labor cost growth periods of 72 to 96 or 19 to 22. And then on the right-hand side, you can see that there is some correlation between unit labor costs and consumer price inflation. The good news is that if this productivity advance in the economy continues for a while, you shouldn't be that worried about inflation heading back up again, the war aside, because essentially we would be in a low unit labor cost growth period. Now, you notice that chart shows basically unit labor costs of 2% are consistent roughly with inflation of 3%. So we're not quite down to the 2% inflation level that we wanted to be. So we did get the inflation numbers out this morning. Low headline of 2.4. The core was 2.5, and the core ex-shelter was only 2.1. And I think they're important. People like Diane Swank and others have pointed out, though, that there were some problems with data collection during the government shutdown, and that has distorted the CPI down a bit. But the number's actually not that bad. There are a couple of things that I wanted to highlight, though, as potential concerns for the future. One is that prices of select tariffed goods kind of fell in the second half of 2025, but they've rebounded again recently. So maybe a lot of these suppliers of things like appliances and floor coverings, etc., and computers even have kind of waited till the new year, and the green shoots that are appearing in the economy to be able to pass on more of the prices of tariffs in that thing. The right-hand side is a really damning indictment of the US grocery system. And I looked at this because I've just come back from a holiday in Spain, and it's amazing how different it is to shop for groceries in the US versus in Europe. So while things like sugar, coffee, and cocoa prices have plunged, prices of coffee, cookies, bread, and snacks are still rising, in some cases rising fast. And these prices have remained very sticky, and I'm not sure whether we're actually going to see a payoff eventually. Another thing to worry potentially about inflation is that, yes, we have had a decline in underlying inflation since the end of 2024, a very impressive decline. We're still above where we were in 2009 to 19. The question is whether under Walsh, the Fed will kind of abandon temporarily the 3% inflation target. And then Goldman Sachs has this outlook for PCE inflation, which is the Fed's target, the core over the next couple of months, increasing again to about 3.4%. PCE is a cleaner inflation because it doesn't worry about these fudges that the government had to make. So I would say that inflation has been benign. If you look at the outlook for unit labor costs, it will probably stay benign. But there were a couple of concerns going into the war. So just finishing up with the outlook for rates and bonds. Well, again, this has been a wild month. On February the 2nd, just after Kevin Walsh was announced, the market was pricing in 2026 about 40 basis points of cuts, and by 2027, February 27, just before the war broke out, we were down to a point where the market was looking for 3 cuts by the middle of 2027. Quite a cutting cycle. Now, go back to today after the war and things like that. The market is actually basically where it was back on the 2nd of February, but a much more tentative decline in rates over time. And that goes to the issue of the left and the right tail risks. When you don't have many of these risks, people say, well, at this meeting, the Fed might move, the next meeting, it may not move, etc. But when you've got 2 tails, then you tend to have a more gradual path, ironically, for the expected interest rates because there's 2 scenarios. What do I think is going to happen in the next 2 or 3 Fed meetings? I think that ultimately, unless there's some kind of negative surprise in the stock market, or say with the JOLTS numbers on Friday, the Fed is likely to take a pass on March the 18th. It's probably going to take a pass on April the 29th as well, because the day after we'll be getting these very strong GDP numbers for the first quarter. There is some risk that either between now and the middle of the year, there will be one more insurance rate cut, depending on what the Fed's doing. But overall, I'm not expecting that. And then, when we look at bonds, we look at this issue about the US has an annual funding requirement around the world of $1 trillion or more. Despite tariffs, that borrowing requirement didn't change very much during 2025. And so we still have to convince our foreign counterparts to invest in US assets at a time when we're kind of abandoning them in a political sense. And it's important to note that Japan, for example, the 20-year bond, once you account for hedging costs, actually has a higher yield than US 20-year bonds. So that tends to put a floor under bond yields. So ultimately, here's what I'm looking at. I happen to be about right for the 10-year rate in March, but only because of the war. So I can kind of escape from any wrongdoing from having a higher rate when we got down to 4% a few weeks ago. And basically, I still have the same scenario, which is the 10-year rate gradually goes up over the year to between 4.75% to 5%. And right now, I've only got 1 Fed cut that happens roughly in September, about 2 meetings before the midterm elections. And that, again, is conditional on various things happening in the economy. So, again, to summarize, the new Gulf War increases both the left and the right tail risk, the left tail risk being a mild recession, the right tail risk being a melt up in inflation that gets sustained through tight labor markets. But overall, I think the chance of a Gulf, 1989-90 war, recession are still relatively low, particularly given what's happening in the rest of the economy. And generally, I kind of like the idea of interest rates, particularly as you go further out the curve, gradually increasing during the year. So with that, I'm going to stop at this point and see if any of my colleagues have got any questions based on that very long detour or journey around the current economic data.
Hey, John, that was very informative, as always. It's really clear why people sitting in some pretty big corporate rooms and governmental positions have listened to your voice for so many years. So in a moment, Jim Griffin, I think, from Derivative Logic is going to join us, and he has a question, and I may sneak in a couple myself.
That, John, as Steve said, and I'm just going to keep it to one question today since we're right at 10:30, and everybody. We try to keep this right at 30 minutes for brevity. John, relative to one of your earlier slides where you said kind of the CPI impact today of higher energy costs is maybe smaller than it once was. If there's any kind of real inflation risk from this current Iranian war episode that we're all in, which, as we all know, is all over the news headlines every day, all day for the last 10 days. If that inflation impulse shows up, do you think it will show up in things like supply chains, a fiscal response, or inflation expectations? Or could you just give us some color on where it might show up?
Yeah, that's a good point. The 1-year inflation swap since the start of the month has gone up about 40 basis points. So that's kind of half of the gap between $100 oil, immediately going to $100 oil and staying there, versus kind of a midpoint between that. So there definitely has been an increase in inflation expectations in the inflation swap over that period of time. But yes, if I was looking at the risk of greater stagflation, like the first Gulf War, which is a mild recession, but inflation going to 6%, I would be looking at various things like the supply chain pressure index that New York Fed puts out, which is a composite based on things like the Baltic Dry, the passage of ships through various parts of the world. I don't think this thing is going to spread to Asia, where we get a disruption to ships coming from Asia into the US. I'd also be looking at things like Henry Hub and other natural gas prices, because, as I say, natural gas and oil have about the same contribution to GDP indirectly. So I would assign that, a melt up in inflation of the kind that we got, about a 1.5 percentage point increase that we got during the first Gulf War, as being about a 25% chance, not a seriously strong scenario. And then the risk of that contributing to some sort of slowdown in the economy, I would also rate that about a 25% chance. They are things that we have to worry about in the near term, not put into our consensus forecast, but that optionality in the risk that that kind of thing starts getting fed into interest rates.
The index that you mentioned first, could you tell me what that is again? I've never heard of it. Meaning the combo of the bulk dry and all of that. What was the name of that?
The New York Fed every month puts out something called a Global Supply Chain Pressure Index, GSCPI or something, and that takes into account that went through the roof during the pandemic, and it has edged up from very low numbers in the last few months. But it correlates fairly well with good CPI inflation because some of those things get embedded in the price of goods that are coming into the country. So that is something I would definitely be watching, those various things as they relate to shipping channels and supply chains. And as I say, so far, you look at data coming out of places like Taiwan, Hong Kong, Singapore, Vietnam, even China with their trade numbers for January, February. We haven't really seen the kind of disruptions to trade. There is also something that actually a Netherlands think tank puts out that we used at CalPERS a lot, called the World Trade Monitor, which on a seasonally adjusted basis looks at global trade activity. It takes all the non-seasonally adjusted numbers, turns it into seasonal. That's only been updated to December, so it's that data comes out with a bit of a lag. So I'd say the most prescient would be that Global Supply Chain Price Index.
Well, terrific. I've got a question, if you don't mind, John.
Go for it, Steve.
So many of Derivative Logic's clients are less concerned about the level of rates than they are about the volatility of interest rates.
Mm-hmm.
So if we end up in a moderate growth, moderate inflation scenario, like you made a case for, do you expect that rate volatility will normalize, or could we still see elevated volatility, even if the Fed funds rate itself doesn't move very much?
Well, that's a good point. The MOVE index that Bank of America puts out, which is essentially the equivalent of the VIX index in the stock market in terms of bond volatility, that has been incredibly stable since a brief spike after Liberation Day. And it goes to the issue of the taco trade, that President Trump has always, particularly now with a mind to the midterm elections, has worried about the implications of his policies on his base and in general, for independence, independent voters. So, but I think, as Jim pointed out on a separate chat that he and I have had, once you let the genie out of the bottle with the Gulf War, you lose a little bit some control of the narrative. And so that kind of taco trade, which tended to dampen volatility, I do think we'll probably see a slight increase in kind of the sustained level of volatility in the bond market. But I don't really expect that to get too high. There are still plenty of levers to be pulled by Besant at the Treasury and Warsh when he comes into the Fed in terms of controlling the narrative on volatility in bond yields. So I would expect this kind of the steady state level of volatility to be increased a little bit, because you can't deploy the taco trade in the same way that you did before, but not go too high.
So do you think volatility, the regime we saw from 22 to 24, was a temporary reset after a decade of suppressed volatility? Or could that become the new normal?
Well, you talk about stagflation. We had the supply chain issues. We had the massive government spend at that time by both the Trump and the Biden administrations, and a massive increase in the amount of savings given to the consumer during that period of time. There's a potential to have another episode like the pandemic episode. But again, I would, things would have to really get out of hand from here. This have to turn from essentially some kind of grand police action kind of deal into a major war with a long-term closure of the Straits of Hormuz and, increased global terrorism or something like that, to be a significant stagflationary situation that would increase the volatility in the rates market.
Oh, very good. So given the outlook you've laid out today, what do you think investors and corporate finance teams are most likely to get wrong over the next year when they position themselves for interest rates and the economy?
Well, in terms of getting it wrong, I'm not sure that's the right way to think about it, because everyone is confronting the same set of facts. Again, with the left and the right tails have probably become, from 5 to 10% to 20 to 25% on both sides of the market. So, protection against volatility is a good thing, I think. Not being protected against volatility is something you could potentially say is wrong. But also this idea that Kevin Warsh is going to be able to come in and effect immediate cuts to the interest rate rather aggressively like the president wants, I think that would be wrong thinking. We had a very good podcast with Ethan Harris, ex-chief economist from Bank of America, talking about the difficulty Warsh is going to have establishing himself as the leader of the Fed. And I think that would be wrong-headed to expect that to happen, but also wrong-headed not to potentially at least consider, depending on the price of hedging, to hedge a bit against volatility.
And if you want to hear more about John's thoughts on that, look up his interview with Ethan Harris, which extensively goes into that topic and is very eye-opening. And that's also available on our website. So, John, I want to thank you for those thoughtful answers. Always spot on and very informative.
Appreciate it.
Let everybody know we thank you for staying on. Everybody that comes into the room tends to stay to the end, which we're of course delighted to see. And please visit our website, derivativelogic.com/what I learned this month, or WITM. And that's where you'll find the replay for this. You can also find it available to you on our LinkedIn page, the Derivative Logic page on LinkedIn. And there'll be shorter excerpts made available there for you as well, if you want to share them and and let everybody know the kind of insight that you have just heard for yourself. So one last question, John. If we were here, well, we will be here a year from now. Given this case that you've made out, what do you think is the thing that economists would be most surprised, the current consensus, they'll be most surprised about what happens a year from now?
The consensus, of course, is evolving. That's a typical economist answer.
How many hands do you have?
Yeah, I think the surprise will be that basically the resilience of the economy, and I think one of the surprises in the year looking back is that despite all this disruption and the increase in uncertainty, the economy's actually been quite stable. That 2.5% demand growth, inflation kind of soft landing toward 2.5%, and economists actually expect that to continue. So the surprise, I guess, would be in the tails. And I think the surprise in the tails would potentially be that we haven't got inflation under control as much as we thought we did.
Okay. Well, thank you again. I'm going to end it now. Again, just thanking you all for watching, and look for the replay shortly. And that's always going to be available on the Derivative Logic website. There's a convenient button at the top for what I learned this month, and that will get you right to the replay immediately. Until next time, I'm Steve Morris. This has been John Rothfield, and please be well, and we'll see you again shortly.
Derivative Logic, calming complexity.